Podcast. Thank you very much for being here. I am Jeff. And we're going to get right back into some stock market news and everything that's going on out there. And I just want to say very quickly, thank you very much for being here, supporting the podcast, and voting in the polls, getting over to the Let It Grow Investing page on Facebook, and doing all the things over there to help build the community. I definitely appreciate it. And I guess we can dive right in. So. Shortened trading week. We did have the holiday weekend, which a lot of people took Friday off. The market did not. The market actually moved up on a lot of that job. Unemployment news, we had a new high unemployment rate at 4.1%. So that kind of eased some tensions in rates, but also made a little bit more concern in consumer demand, consumer spending, how much we're going to be able to buy, how much we're going to be able to spend, and what segments of the market are going to be affected by that as well. We had tech going for another rally. I believe the S&P 500 closed at another record high on Friday. So we're definitely watching that. I'm taking a look at the CME, the fedwatch tool, as to what's going on in the market, where we anticipate being by the end of the year as far as rates are concerned. And from here, right now, where are my notes? I know I've got it written down here. We've got potentially down 75 basis points in December. 27% of people are saying that we are going to be down 75 basis points in December by that meeting on the 18th, I believe that is. And then 47% are saying we're going to be down 50 basis points by December. So now that's either one cut, potentially two cuts. Might be two or potentially three 25 basis point cuts. I don't think that that's what's going to be. I think we're probably going to end up with one or two 25 basis point cuts. But we're starting to see the market breaking, a lot of that demand falling off. So a lot of these different plays that we've been watching, whether it's Nike or Target, some of the different consumer staples that are out there, some of those are starting to fall off. Some of that discretionary funding is going by the wayside. If you looked at concerts and travel and what was the other one? I did have it tip of my tongue. I can't think of the other movies. Yes, movies. That has all gone down year over year. So the spending has definitely slowed in those areas. And that is definitely something that we are watching as well. So a lot of different things out there that are still cooking. We're still seeing a lot of that AI spend, the chip spend. We're looking at, Elon Musk building out more of the Gigafactory with supercooling powered by SMCI. And also, I believe it was 350,000 new NVIDIA chips that are going to be in that. And he went on the record basically saying, if you're going to be in the game, play to win or don't play at all. And he's really trying to take over that front, whether it's the mapping, robo taxis, and everything else that's going on out there. So they did deliver some great delivery numbers. They did surprise to the upside. A lot of people did not think that Tesla was going to be able to do that this quarter. It looks like the interest rate offers that they had on the Model 3 and Model Y were a big driver of sales. So a lot of people that weren't able to get great funding from other manufacturers, they went out and bought those Teslas. And we definitely saw that. That was definitely a big spend. Elon Musk's pay package getting approved, that was another big driver. And then going forward, just the different things that they are looking to launch. And even I saw one report that said the Cybertruck numbers, while they weren't publishing it, they did have those recalls, which some people thought was bad news. But it did kind of lead into how many vehicles or how many Cybertrucks they actually sold in the first couple months. And that surprised to the upside as well. So yes, there was recalls, but it did give out a little bit more insight to the actual deliveries that they were able to produce with the Cybertruck for this couple months that they've been out. So we've got that there. We've got Boeing, man. And still, nope, not buying it, not doing it. Boeing is yet again in hot water. They're looking to potentially revise some of these charges that they had to actually make them criminal charges from the door that flew off the plane. What was that? Back in, I don't even remember. Was it January, December? I'm not even sure. They are potentially revising these. They are looking into what was going on and who knew what beforehand. And if they do revise these to criminal charges and Boeing is found guilty or pleads guilty, this will have severe implications for Boeing stock going forward. Now, they won't be eligible for a lot of government contracts if they are found to have criminal practices on their record, which would be absolutely massive. They are one of the largest people that deals with, defense contracting and things like that. They are also the largest exporter. I believe that is what I read was that they are the largest exporter from the U.S. as well. So that would be absolutely devastating to Boeing stock. And man, I am still, even if they are not guilty, you might see a little bit of rebound, but man, they cannot get out of their own way. I would not buy Boeing with anyone's money. I just wouldn't do it. There is too much going on. There is too much uncertainty. There's too many problems. And like I said, yet again, another problem without results. And man, I cannot even begin to recommend this stock. Even if it looks cheap, there is just so much baggage on the other side of it that it almost feels like you're buying, and it's not a Chinese company, but it almost feels like it's as risky as buying a Chinese company with a valuation that looks great, but I cannot wrap my head around all the problems that they have going on and endorse this at all. So that's a firm stay away from me. I'm not doing it. I wouldn't risk it. Could they get it back on track eventually? But man, there are so many other better companies, better stocks to invest in. I would not touch it. So that's that. We've got unemployment. Yeah, we talked about that. We talked about the Fed. We were looking at some different stocks that we were looking at. We were looking at Nike. I think that was on this past investing challenge. I guess we'll go right through those. For week 28, we were looking at 5 different names. That is normally what we're doing around here. So the 5 that we threw out were JP Morgan, as some of the investment banking comes back in, IPO market kind of spurs back up. We were looking at Google. For all things that is Google, we love that stock around here. The whole NASDAQ is really moving up higher. And I definitely think that they have a bright future. We've got Nike. They had missed deliveries. They had definitely some severe problems. One of the biggest sell-offs as we looked at this one last week. We were looking at Johnson & Johnson, J&J, because I think that healthcare is a safer spot to hide out right now. A decent dividend. A lot of different things going well for them. And they have a lot of baggage that was holding them back, but I think we are starting to get past that. So I do believe that some of those stocks are starting to look like they could be potentially bought into. Number 5 was going to be Micron for all things chips, all things commodity chip making. NAND, DRAM storage, I still believe that is a very viable place to be in this market. And one with a more decent valuation than a lot of the other chip manufacturers that are out there at this point in time. You guys did vote. Thank you very much for voting. Again, that is over on Facebook, Let It Grow Investing, and also on Spotify. You can vote in the show notes as well. And thank you for those that did vote. We are going to be buying Johnson & Johnson, J&J, for week 28. And quick recap. Let's take a look at Johnson & Johnson real quick. I believe we had around 20% of upside when I looked at this last. Yeah, 19.94%. I think that's about almost as close to you can get to 20% as we're going to see. So, yeah, sitting at 146.48. Decent amount of upside. We're sitting 146. So average price targets to 175. So good amount of room. Great amount of safety. Dividends at 3.4%. PE sitting at 21.7, so fairly valued. EPS very strong at $15.2 dollars per share on the trailing 12 months. So a lot of things to like about this one. A lot of things after COVID that this one really wasn't firing on all cylinders. But I think we're starting to get past a lot of that. So I'm definitely happy to see this one. And the one that I was starting to say about commodities, Nike, man, I'm in a lot of different stock groups out there. I was listening to someone say, hey, I would not buy Nike right now, and here's why. And a lot of that was based on what they are seeing out in the market or at events, right? And I think this is actually starting to make more sense that they do have a lot of competition out there, and they used to have a running event kind of down pat. That was just, that was like their lane. And anymore, it seems like, there's so much competition, whether it's Hoka, Brooks, ASICS, On. There's a lot more different running shoes that are out there, and a lot of people are starting to notice these other brands and not going with your typical Nike shoe, and they're going other ways. And I definitely think that that is true in some areas of the market. I still believe that basketball, football are still going to be Nike dominated. But I think that some of their market share in other spaces is starting to deteriorate. And I think a lot of that is to do with some of the political views. I don't know if it's so much to do with the actual shoe and actual product, although I do believe that some of these other manufacturers are doing a great job as well. I do believe that they are losing some market share in some of these key markets. But even with that, I think that if you are looking to buy Nike, it's going to remain down for a while. I do not think that this is going to be a quick turnaround from the standpoint that the consumer demand is weakening as unemployment rises. I don't know that there's going to be this quick turnaround for Nike stock. So I don't know that it is dead in the water, but I think you are going to have at least 12 to 16, 18 months to go ahead and purchase this thing if you believe in that turnaround story. PE is still fair. It's sitting around 20. The quarterly dividend is around, the yield is around 2%. EPS at $3.40. A $75 price on this one, which we haven't seen in forever, it feels like. We've got, what's the upside on this? 22.8% of upside. Some of the recent ones, Goldman came out and said it's a 105. Deutsche Numis came out and said it's a buy at 92. RBC says hold at 75. Two more holds also in July from Argus and Barclays. So I do believe that we've got some kind of turnaround story. I do think that some of the market share has deteriorated, but the big short-term concern is consumer demand for this one. And I don't think that we're simply just going to get away from that. So I do think that they've got some major headwinds. Some they're going to get by just as time passes, as rates come down, as unemployment hopefully gets kind of handled, as inflation gets handled. I think a lot of these things are going to start to come back in shape. But I do believe they also have another issue when it comes to the market share that they are losing to other competitors. So that is definitely one thing. Similarly, I think that Target is getting out of a lot of these different problems that they were facing with inventory and supply chain. And I think as we go forward, we're going to have some of those consumer spending problems, but I do believe that Target is going to start to rebound sooner than Nike potentially will. Simply from the standpoint of there's a lot of consumer staples that they're going to be selling. There are some cyclicals. They do have some retail, some clothing, some technology as well. But I think a lot of that business is going to remain strong, at least on that consumer staple side, as people really look for good value right now. Yes, they're going to do some better pricing, especially for their Target members club. I forget what it's called, Target Circle or whatever, the Red Circle, whatever it is called. So I do believe that those are still going to be very beneficial. I think they still have a very strong following. And I think that the business is going to recover as they get away from some of their problems as well. So I think more short term, I would probably buy Target over Nike. I think long term, both will be fine. But I do think that in that short term, that consumer staples might be the area that is going to do a little bit better, as rates are still high. Even if we get 50 or 75 basis points of cuts, we're still going to have a lagging effect, as people are still going to be out of jobs, and the market might start to rebound before some of these jobs, some of the consumer demand really starts to come back. I think the market is going to be looking out 6 to 12 months, and we're not going to feel those actual effects for that 6 to 12 months. So I think for those reasons, Target is probably more of a buy for me in the short term rather than Nike. But there are a lot of different ways to look at this market and really where you go from here. I still believe that data centers are going to be a great way to look at some investing dollars. I still think that the energy side of that is going to be huge. Companies are definitely building out these spaces as we have more and more demand for AI, for data, for all things advertising, cloud. I think that is going to be a continued driver for growth. And as rates come back down, we should start to see the Russell, the small cap stocks, really starting to move up as well. You could look at the IWM, the Russell 2000s small cap ETF. That could be a good way to play it. The Dow hasn't been performing as well as the NASDAQ and the S&P, which is kind of tricky, right? As the NASDAQ normally is more rate sensitive. You would think as rates are staying higher that the NASDAQ would be slowing. But I think there is just such a demand for AI, for cloud, for everything that the NASDAQ stocks are focused on, all things software, that those are going to continue to drive up. And I believe that even when rates start to come back down, the demand for the NASDAQ stocks is still going to remain high. I don't know that I'm going to be an overweight buyer of the NASDAQ right here. I'm probably more looking to sell some of those stocks as some of these things really move up higher. I did write a covered call on Tesla, as Tesla had about a 40% run in the last month. I did go ahead and write that covered call for $300 for August 9th. I generated around $700 worth of premium for writing that covered call. And if the stock goes up another 50 some dollars, I would be a seller at that $300 price for August 9th. So play that I've got going there. I see a lot of people are shorting Tesla. I understand that as well. A lot of bets that the stock is going to go south and that this is just a quick blip higher and we're going to settle back down really quickly. That could definitely be. I'm not saying that it's not, but I know for me, if it gets up to 300 in the next month, I am going to be selling about 100 shares of Tesla stock, which would generate a lot of capital to potentially buy some more dividend names and do some different things there with my money and rebalance the portfolio to kind of look forward to see what's going to be out there for the back half of the year. As rates do come down, I think a lot of these different stocks are going to start picking back up. So that's one of the plays that I've got. What else did we do? I know we talked about selling off Qualcomm. I did have that covered call. I still believe that Qualcomm stock is probably one of the cheapest, most fairly valued chip stocks in the game right now. We still got all the Apple concerns are always still there for Qualcomm and what happens going forward as Apple builds out their own chips. I am having some problems here with this loading correctly, but I'm going to try to get through this one and see if I can't pull up some of these numbers here. If not, I'm going to have to just go with my phone and see if I can't get that pulled up. And if someone's got some kind of tech guy that can get my internet moving smoother and more stable, that would be awesome. So if you are an internet guru and a Wi-Fi wizard, just feel free to reach out. I would definitely appreciate that. What do we got here? We've got a decent amount of upside from Friday, right? I was talking about that when we had ChargePoint was a massive mover. Up about 10%. And I think a lot of these things are on the fact that a lot of EVs are being sold as Tesla went up. Now they did close around 251.50. Apple up about 2% on Friday alone. Now they are at 226. Google up 2.5%, 190. Palantir up to 27.23. I'm going to have some more covered calls on Palantir as well. Meta, man, we can't stop Meta either. We are up 5.8% on Meta for a close price of $539.91. And a lot of great moves from a lot of these big stocks. Another one I did want to congratulate you if you did listen a couple episodes back, right? It was Adobe was one of the ones that I was buying. I was buying this about a month ago in the mid 400s. Now we're sitting at 578. I will say that I am not buying any more of this one right now. The upside is very limited in my opinion. I don't know that it's going to break 6.25. I would probably stay put where you're at on this one. I would hold this one for the long term. I do believe it's a great company, great way to be in software and AI. but I'm just not a buyer of it at this price point after this really solid run we've had in the past 6 weeks, right? I'm up about 21% on that play. So a lot of different things here that I am seeing that are really doing well. Some of the ones that are trending down, we had NEO, that one. I think there are some new tariffs on China EVs. I think that is affecting that one as well. We've got MPC trading down to about 170.74. I think my covered call on that one was at 175. That triggered. I've been out of that one pretty good for a while. I have a couple shares. That's the only reason it's why it's in this portfolio right now. Man, Enphase is still getting pummeled. This year we knew was going to be bad for them. Second half is looking a little bit better, but it's going to be until like next year before this thing really starts to recover. And I don't know that the growth from this year and next year is going to get it back above where it was in 2023. So I think those are a lot of the reasons that Enphase is still down. I did buy some more shares. I think I said that last time. I would still be looking to add some more in this price point. I do think that this is going to have a decently bright future. It's just not its time right now. That's really, I think, the case. And even with Meta, when you see that one up about almost 6%, a lot of the headlines were Meta's moving up massively on seemingly no news. We've still got Albemarle, man. That one is getting kind of kicked in the teeth, down to 98. That one is not a winner for me. I'm down about 29% on that. I did have a sell order on the upside for a premium, and we are a good ways from that at that point, or at this point. So I'm not selling that one right now. I do need to carefully watch that one. JP Morgan, man, that one is doing well. It did trade down on Friday, but I'm still pretty happy with that position. DraftKings, we're sitting at 37. Oh, man, I really think that this one can still be a great stock. And hopefully long term, it does still have some room to run higher. I did also see something on Uber. I believe it was out of Massachusetts. I think they ruled to have pay for Uber drivers at $32.50, I believe was the actual number for labor wages on Uber. So Uber prices are probably going to go way up in that area. I believe it was Massachusetts. I might be wrong on that one. I don't have that in front of me. That is definitely something to consider if you are buying that stock. What else was there? There was something out of DC. Oh, man, that's going to bother me. I know there's an article out of DC where they did. Oh, boy. I forget that one. I know it was worthwhile, though. So we're going to roll right back into week 29. And what I'm looking at this week, why I'm looking at it, and where we go from here. First up is going to be Coca-Cola. Well, this one we did buy this time last year, week 29. This is what we were buying. I still really believe that Coca-Cola is a great stock to buy in this market. The Dow has not run up as much as a lot of the other stocks. Consumer staples, the non-cyclicals, have not really taken off. It is a 3% dividend yielder. We're sitting at $63.76. I think that this thing had a decent amount of upside. I did not look at this one as closely, so please bear with me. 8.2% of upside. Average price is $69. High is 72. The low is 65. So the low is still above the current trading price. The high gives us about 13% of upside from where we're at. So I'm pretty comfortable buying this one. I think it is a safe, sleepy, old guard stock that you really can't go wrong with. And yeah, I mean, I think it really does fit well for this market, and the fact that everything else is really at all-time highs. Number two, I keep seeing the Zyn nicotine pouches taking off. The number on sales has been through the roof. It continues to grow, and that was the DC story. I got it. I did it. Look at me go. DC was trying to ban the flavored Zyn packs from Philip Morris, and investors basically shrugged this one off as a nothing burger. And man, I think that this stock, while a lot of people don't like the Zyn stocks or the Zyn stocks, we've got a company that is that old guard tobacco name with a 5% dividend yield, but they are growing, which is rare anymore that tobacco stocks are growing. But there is, I want to say it was 20% of upside on this. This one is actually a lot less. Saying about 7%. I want to say that Reuters said it was a good bit higher. So let me pull up the Reuters report. But I do believe that this one gives you a very safe dividend. The PE was cheap. The PEG ratio was cheap. I want to say price to sales was a little bit high, but nothing that was too concerning for me for the amount of growth that they had going ahead of them. So we're at 102. Trefis says about 5.5% of upside. Let's take a look at what Reuters says here. We've got Reuters says about 10% of upside. Forecasted growth for 24, about 5%, and for 25, 12%, which you're really not seeing from a lot of other tobacco names. Dividend growth, only about 2.2%. Dividend payout was 86.7, which I normally don't like. But, I mean, it is a cash cow of a company at this point. So the fact that they're pushing out any kind of growth is somewhat impressive at this point in the game. Forward PE sitting at a 15.5. The forward PEG ratio is at a 1.6. Their 5-year average is at a 2.5. So they are trading well under their 5-year average on that forward PEG metric, which I think is very important to note in the fact that they're actually posting up decent gains on the growth front. Price to sales is actually lower than their 5-year average. It's a 4.4. 5-year average is a 4.5. S&P 500 average is a 2.9. So again, trading a bit higher than the S&P, but also cheaper than their 5-year average. So a good way to get a decent dividend, 5% handle on that dividend, and roughly 7-8% of upside, depending who you're talking to right now. Those DC bands might have something to do going forward, but that is such a small portion of their business that I think that is going to be kind of swept away. And ZYN is held by the foreign subsidiary of Philip Morris, which is Swedish Matchco. So kind of indirectly held through Philip Morris as well. So that's number 2. Number 3 was going to be Constellation Brands, and that is STZ. Another alcohol company that I still believe is going to be strong through pretty much any economical environment here. We've got a stock, you're sitting around 260, average price target sitting around 300. That's about 15% of upside. We've got a smaller dividend on this one, but a decent amount of growth when it comes to Constellation. So we're looking at the company that owns Corona, Modelo, Robert Mondavi. We got Miami Wines. What other wines we've got? Let me see if I can't pull that one up. But when I'm looking at Reuters, I'm trying to do 2 screens here, we've got 20% of upside on Constellation. So I flip-flopped the 2, Philip Morris and Constellation, 20% of upside. We've got 7 strong buy ratings, 16 buys, 2 holds, 0 sells of any kind. Forecasted growth is 6.3% through the end of 25 and 13.5% by the end of 2026. So some decent growth there. Dividend growth, double digit at 11.3%. Dividend payout at 39.2%. So a lot lower on that dividend payout ratio, which I like to see, meaning they can up that dividend more and continue to give us those double-digit returns on growth side for the dividend increases. We've got forward PE at a 12% discount. We've got forward PEG at about a 30% discount to where they normally trade. Their 5-year average is 2.4. Their forward PEG right now for the next 5 years is a 1.6, meaning that this is a cheap stock. Price to sales here is a 4.7. Their 5-year average is a 4.3. So yes, I did flip-flop these in my mind when I was trying to remember them off the top of my head. So I'm definitely liking this one. 1.6% dividend yield, but we do have more upside, and the growth is looking pretty strong, and we're not paying that much for the growth that they are able to give us. The brands that they have, company overview, Kim Crawford, High West, The Prisoner Wine Company, Casa Noble, and Mi Campo. Beer, wine, and spirits, corporate operations, and other. U.S., Mexico, New Zealand, and Italy are their main markets. So a lot of different things that I like going here. I like the growth. I like the amount of upside and the economy. I think that this is going to be a decent way to play this economy with a stock that is not at the peak. I think we got a decent amount of upside, and I think it's a decent entry point from here. So that is going to be number 3. Number 4, probably the behemoth of the group, probably the one that you guys are going to vote on, but prove me wrong. That name is going to be Visa. Man, I still really, really like Visa. I know we looked at this one about 6 weeks ago. The dividend is not as noteworthy. It is a 0.7% dividend yield, PE sitting at a 30. We are at 270 per share. We've got a decent amount of upside on this one. We've got a great company. There is no economy that Visa doesn't work well in. If things are booming, people are spending. If people are not earning, people are swiping those cards. So we're sitting at 270. Average price target being 316.63. About 17% of upside here on Visa. I really like the name. It's definitely one that I think is going to be one of the next $1 trillion companies. We are currently, let's take a look at the market cap, and it's not even a far stretch. This one is easily going to grow into it. It is about a $541 billion company right now. So when this thing doubles, it'll be at a market cap of $1 trillion. And I do believe that we're going to get there within the next 6 or 7 years, possibly by 2030. I think this thing will double and will be a $1 trillion company. So I definitely think that is one worthwhile to look at right now. And that's what the 4 that I've got. I was really looking for a 5th, and there's probably a ton of them that are out there that are worthwhile, but not any really came to mind that are just screaming buys. Let's take a look. Let's see if we're missing any kind of healthcare names that really are looking like a buy right now. United Health, we're back in the 480 range. That could be a good 5th place. About a 15% upside here on United Health. I always like them in the 4s. I'll go ahead and write that one down. I do believe that no one's going away from healthcare. That is going to be one of the last things that we go ahead and cut if anyone needs to save some money. I don't think that's going to be their first thing to cut, especially if they are still employed and the unemployment rate has not dropped that much. So maybe we'll throw in the United Health as a number 5, and I'd be happy adding to that position as well. So definitely some other runners up. Definitely was looking at some other credit card companies, and a lot of the consumer staples really make sense to me here. Some of the tech stocks have really just run too much for me to go ahead and want to put more money into those at this given point in time. So I am going to steer away from them for right now. I'm going to hold them and potentially write some covered calls to sell them at a higher price if they continue to run up, and know that I'm trying to plan an exit strategy that really makes sense. But thank you guys very much for stopping by. I'm going to get back to my weekend. It has been a long one. It has been a great 4 days that I've had here with family, and I'm going to get back to that. So thank you guys very much for stopping by. Thanks for tuning in. Make sure you like, subscribe, and share. And get your votes in. Get your votes in for one of these 5 names, whether it's Coca-Cola, Philip Morris, Constellation Brands, Visa, or United Health. KOPM, STZ for Constellation, which doesn't make any sense for a ticker. V for Visa, United Health is UNH. That's the 5. Let me know what you guys think in the comments. Is there one that I'm missing? There probably is. I'm sure that there is. But I would definitely love to hear what you guys are buying, what you think of the 5 that I'm coming up with, and where we go from here next week. So thank you very much. I appreciate all the support out there, and I will talk to you guys next time.